Once again, good morning, good evening, everyone. Tonight what is it called? We'll be looking at investment in associates. And when we talk of associates are basically an investment in associates, of course, where an entity has a significant influence in another entity. So we said accounting for investments in associate and joint venture (IS) over which the investor has significant influence, and that is neither a subsidiary nor an interest in joint venture. What do we mean by that? Before we can refer to an organization of an associate, the entity that is investing in it or the person that is investing in it must have what significant influence. And what do we mean by significant influence? It is the power to participate in the financial and operating policy decisions of the investee, but is not control or joint control over those policies. So when we talk of significant influence, it is just the power to have your own contribution or have your own input in the financial and operating decision of the company. But it doesn't mean whatever you say is what they will do, or whatever you say is what we know. Because what you only have is significant influence, not control or joint control. So for when we say a significant influence exists where you have between 20 to 49% because we usually see 50% as a joint control. We usually see 50% as a joint control. Are we getting it? Are we getting it? Am I communicating?
Yes, sir.
Okay. So we have sorry. So how do we account for associates? We account for associates using what we call the equity method. We account for associates using what we call the equity method. And what do we mean by using the equity method? Simply means the investment will be recorded initially at its cost and it will be subsequently adjusted for what? Post-acquisition change. Post-acquisition change, like change in the post-acquisition changes like share of post-acquisition profit of the associate or impairment in the investment in associate or impairment in the value of the associate. Now, when we are consolidating, we will only consolidate the report of the parent and subsidiary. We don't consolidate the details of the associate. However, even though we don't consolidate the result of the associate, we show a line item. Of the share of the parent company in the associate. The share of the associate's profit for the year is being shown in the statement of profit or loss. But what we will share is their profit after tax. That is, if we have an associate now, having done all of the necessary adjustments, maybe the associate's profit after tax for the year is 2,000 and we only have 35% in it. We calculate 35% of that 2,000, and that is what we will show in the profit after doing bringing the finance cost and finance income. We add that share of associates profit to it before we get the PBT, before we calculate the taxes. In the consolidated statement of financial position, we don't consolidate the associate also. What we only show is the value of our investment in associate as we have calculated using the equity method. We just show it as a non-current asset. We just show it as a non-current asset. And this is how we calculate the investment in associate. The cost, that is the purchase consideration on the date we are acquiring it. Then our share of any post-acquisition profit we have. Then if the investment in the associate has been impaired, we take out the impairment. And lastly, we less unrealized profit when the parent is the selling entity. When the parent is the one selling to the associate, we less the unrealized profit from the investment in associate. Why? Because the investment in associate we are recognizing is a portion of the net asset of the associate. Of course, and because the inventory the associate is recognizing, part of it is coming from the parent, of which if we are now consolidating it, or let me say we are now including it in the account, they cannot be making profits on their own inventory. That's why we'll deduct it. But where it is the parent, where it is the associate that sells, we cannot deduct unrealized profits from the investments in associates. Rather, we'll deduct it from the inventory of the parent. But the unrealized profit we are talking about here is not the full value of the unrealized profit. Rather, it is what? It is the portion of the parent's holding in the unrealized profit. It is what? The portion of the parent holding in the unrealized profit. Now, for fair value difference, if we have fair value difference on the date of acquisition for a subsidiary, the same way we account for it when we are doing for an associate, the same way we do that, we adjust the subsidiary information for the fair value difference is the same way we do for an associate. But don't forget, the bottom line of doing all of that is just to get the post-acquisition earnings, not because we want to consolidate their results. If we have group balances with the associate, intergroup balances with the associate are what? Are deemed. They are deemed to be what? They are deemed to be outside of the group. So we don't derecognize intergroup. We don't derecognize balances with the associate. Let's say, for instance, now we now have the parent as a receivable from the associate, and the associate as a payable to the parent. We will not derecognize it like we will do for a subsidiary, because we are not consolidating the associate report. We are not consolidating the associate report. As for unrealized profit, the same way we calculate unrealized profit, but unrealized profit must be eliminated. It must be eliminated because you cannot carry an inventory higher than its cost. And when there is unrealized profit, it means we are carrying it higher than its what? Higher than its cost. So what do? We calculate what the unrealized profit should be. I mean, markup or margin of closing inventory, but we multiply by the percentage of holding. If you remember very well, for that of subsidiary, we don't care about their percentage of holding. But in the case of subsidiary associate, we have to restrict it to the percentage of holding of the parent company in it. And just like I said earlier, if the parent is the one selling, we debit the unrealized profits to the group retained earnings, that is the parent retained earnings. We are debiting it there so that it will go and reduce the share of the associate's profit we would have credited there. Then we'll credit it to where? Investments in associates. But where it is the associate that is selling, we'll still debit it to the group retained earnings to reduce our share of the associate's profit but the corresponding entry will be in what? In the inventory. Is it clear? Where the associate pays dividend, because we are sharing profit in the associate with the recognized dividend. That is, if the associate has paid dividend, we what? We'll recognize it, we'll deduct it from the parent's investment income, then add backwards, add back the share of post acquisition profit of the subsidiary. That is what we have in subsidiary associate. Thinking let me see how we'll go about these questions. We only have questions here, and I don't know if time will permit us to go through it all, but let's see what we can do with it. Question 1, who is reading? Someone should read for us. Or do I have any question? Can anyone hear me? Adetola?
Yes, we can.
Oh yeah, now someone should read
Yes,
the
sir.
question. Read the question
Question
now.
1. P acquired
Okay,
80%
someone.
of shares on 1st December 2004, paying $4.25 in cash per share and a further $500,000 in 4 years. P and S cost of capital are 10% and 11% respectively. The balance on S retained earnings on 1st December 2004 was $870,000. On 1st March 2007, P acquired 30% of A's ordinary shares. The consideration was settled by a share exchange of 4 new shares in P for every share acquired in A. The share price of P at the date of acquisition was $5. Only the cash consideration has been recorded. The statement of financial position of the three companies as at 30th November 2007 is as follows. All figures are deemed to be correct. Sabri School of Additional Information. As at 1st December 2004, plant in the Book of S was determined to have a fair value of 50,000 in excess of its carrying value. The plant had a remaining life of 5 years at this time. Soon, during the post-acquisition period, S sold goods to P for $400,000 at a markup of 25%. P had a quarter of this goods still in inventory at the year end. 3. In September, A sold goods to P for 150,000. This good had cost $100,000 per. Okay, $100,000. P had $90,000 in inventory at the year end. 4. As a result of the above intercoupling sales, P's book showed $50,000 and $20,000 owing to S and A respectively at the year end. This balance agreed with the amounts recorded in S and A's book. Sorry. The NCI at measured using the fair value method. The fair value of the NCI at the date of acquisition was $368,000. Goodwill has been impaired by $150,000 at the reporting date. An impairment review found that the investment in the associate was to be impaired by $15,000 at the year end. A's profit after tax for the year is $600,000. Sir, please scroll. Required. Prepare the consolidated statement of financial position as at 30th November 2007.
So I want to believe with all of my explanation tonight, you can do it on your own. I don't need to do it. Right?
No.
Okay. So we have information about P and S and A. And from what they tell us, P acquired 80% of S, and that makes S what? A subsidiary. However, they acquired what? 30% of A, and that makes A what? An associate. So we have to consolidate this. Okay, so we have what do we do? Investment in associates. Question 1. We have P, who acquires S, 80%. NCI, NCI is 20%, percentage of holding 80%, and they also acquire A, what? 30%. We don't have NCI in A. So we have date of acquisition and date of consolidation. The date of acquisition of S, the date of acquisition of A, and the date of consolidation. For S, we have the date of acquisition to be 1 December 2004. For S, we have the date of acquisition to be 1 March 2007. And the date of consolidation, we have 30th November 2007. So that tells us that for the subsidiary, we are doing the post-acquisition period is more than 1 year. But for the associate, it is what? It is less than 1 year. How many months period is it?
Nine months.
9 months. Good. So without wasting our time, we go to the next information. We need to calculate the purchase consideration. And who can assist me? What are the types of purchase consideration we have for the acquisition of S? We have cash consideration, which is what? $4.25 multiplied by, and what?
Different
Consideration. Yeah. So we have multiplied by 80% because they said they are paying 4.25 per share. So that will be multiplied by how many shares do they have in S? Equity share capital 500, and the nominal value is what? At $1. So we'll say 500,000 divided by $1. So that will give us what? Dollar in thousands. Then the deferred consideration, they said what? They pay further 500,000 in 4 years' time. So that will be $500 into bracket 1 plus R. What's the cost of capital? We'll use the parent cost of capital, which is 10%. 0.1 raised to power minus what? 4, since they are paying in 4 years' time. And that will give us how much? Amazon pẹ́ mo kún ní wà ó. Figure.
The cash is 1,700.
The cash is
1,700.
the cash is what? 1,007. The deferred consideration.
The deferred consideration is 341.507.
Kí ló ń sọ o?
341.507.
That should be 341.5. Or we can just make it 342. We don't want to use too much decimal. And that means our purchase consideration will be what? 2041.5. Anyone you are using, just make sure you are consistent with it. As I have chosen to use one decimal place now, I'll continue. All my calculation will be in 1 decimal place. Not that some will be in 2 decimal place. Some 3, some are round up to the whole number. Just make sure you are consistent. Okay? That's purchase consideration of S. For A, they said they acquired the purchase consideration for A. The purchase consideration for A will be what? They said is by share exchange. By share exchange. And what's the share exchange? 4 new shares for every 3 acquired. So that means we'll have what? And they gave us the share price of P on that day was what? $5. Whereas the nominal value is $1. That means we'll split it into 2. Ordinary share capital and share premium. And the calculation will be 4 over 5. Since they said, 4 over 3. 4 for every 3 they are acquiring. 4 over 3 multiplied by what? Multiplied by 30% of what? Of 250,000 divided by $1. Everything multiplied by the nominal value of $1. While for the share premium, it will also be 4 over 3 of 30% of 250,000 divided by $1 multiplied by what? $4. So you know $4 plus $1 now will give us that market price of $5. Oh yeah, figure.
Ordinary share capital is 100,000.
Huh?
100,000.
400,000.
So that means the other one will be 400. So we'll have that to be 500. That's great. So that has been sorted. We move to the next thing. At the year end, plant in the book of S is the subsidiary, were determined to have a fair value of 50,000 in excess of its carrying amount. That means we have a fair value surplus. For who? S. How much? 50,000. And what do we say we will do? The plant had a remaining life of 5 years. So what do we say? To create an additional depreciation. And that will be 50,000 divided by what? 5 years. But don't forget, from date of acquisition to now is how many years? 2005, 2006, 2007. That's 3 years. So we say multiply by 3. And that will give us how much? 30,000. Then, during the post-acquisition period, S sold goods to P. That is, the parent sold to the subsidiary for 400,000 at a markup of 25%. P had quarter of these goods still in inventory. So we say 5. Unrealized profits. S to P. What? 25 over 125 multiplied by what? 400,000 multiplied by 1/4, because they only said 1/4 is what is remaining in their inventory. All of that will give us how much?
20,000.
20,000. Don't let us shoot ourselves in the leg. Though. You know we are quoting the figures in thousands, so let me just put all of the figures under that same heading. So this will be 30, this will be 20.
Fair value surplus too.
Fair value surplus 50. So number next, we have what? A sold goods. In September was when A sold goods to P. And September, they acquired A since when? March. So if A is selling goods to them in September, that means the unrealized profit will count. But if they have sold that goods to them before they acquired them, we cannot calculate unrealized profit on that one, because when they bought the goods, they were not in a group. So A sold goods to P for 150,000. These goods had cost A 100,000. P had 90,000 at cost to P in the inventory. So what do we do? Note 6, unrealized profit. A is selling to P. That will be what? 90,000 is the inventory remaining, divided by the total cost of the inventory, 150,000, multiplied by what? Multiplied by 150,000 minus 100,000. We've done something like this before. 150 minus 100 is giving us the profit on the entire sales, 50. 90 over 150 is giving us what percentage of the goods they bought is yet to be sold. We use that to multiply the profit. We'll know what amount of the profit is yet to be realized. And that will give us how much? Ẹ má dá mi dúró donígbèsè o.
9.
That should be 30. Are you sure? 9 or 30,000?
It's
It should
30,000.
be 30,000. No. Then we now
30.
multiply by the 30%, which is their percentage of holding. So if we multiply by their percentage of holding, what do we have? They hold
9.
30%. That will now be 9,000. So we can put the
9.
naira, the dollar in thousand here and say 9 is the unrealized profit. So note 7, we have what? We have, as a result of the above intercompany sales, P's book showed 50,000 and 20,000 owing to S and A respectively. We say intra-group current accounts. What would that be? 50,000. But that 20,000 will not come here because A is not their subsidiary. A is not in their subsidiary, so they are not consolidating it, so they cannot recognize the intergroup balances. The NCI is measured as fair value, and the fair value on that date is 368. No problem. Goodwill has been impaired by 150,000. Fine. At the reporting date, okay, an impairment review found that the investment in the associate was to be impaired by 15,000 at the year end. Good. A's profit after tax for the year is 600,000. Why are they giving us the profit after tax for the year? Because A is a mid-year acquisition. A is a mid-year acquisition. So we'll say 8. Retained earnings or post-acquisition earnings. Post-acquisition earnings. Or let's do it the other way around. Retained earnings at acquisition for A will be what? We'll come back to the SOFE. Okay, they've given us their profits for the year. So, okay, we have what? The retained earnings at the end of the year to be 1,200. Now say minus open bracket what? They were acquired for 9 months. Multiply by how much is their profits for the year? 600,000. So this will give us what it should be. 600,000. But we'll use 600. This will give us what their profit would have been. And how much?
Sir, we not do discount on one.
Thank you very much for that. I noticed, but I just kept my quiet that okay, let's see. Let's see if anyone will notice. Okay? We are to do discount on one. And what is discount on one? Because we are doing discount on one because we have deferred consideration, and the deferred consideration would have accrued interest. So the discount on one, because this is 3-year period, from date of acquisition to now, it's 3 years already. So we'll say year opening balance interest at what rate? At 10%. Then closing balance. So what do we have? Year 1 opening balance is what? 341.5. Interest at 10% will be what? 34.2. And what will be the closing balance?
375.65.
375.7. I told us let's maintain the same format also 1 DP. 375.7. 375.7, and this one will be 37.8. So what would that give us? Oh yeah.
413.2.
413 points.
0.2.
0.2 or 0.5? Let's see. 8 plus 7 should give you 5 now. So this will give us what? 41.3. No, 41.4. Oh, sorry. I was the one that made a mistake here. This will be 37.6. At 7.6. So this will be 413.3. Okay, we have what? 41.3. So what will that give us in total? 456.6. Abi? We don't need to do the 40 here, but I'll just show us, but I will clean it back. 456.6. If we are to calculate the interest, it will be what? 45.7. And if we add 45.7 to this, how much will that give us? So that's giving us 502.3. But it's giving us 502 because of what? Approximation. It's because of approximation, but we don't need it. So we'll just continue with what we need. Those 3 years we've accounted for. So what's the total interest? So that should be 113.1. Note 10, what do we have? So having looked at all of the adjustments, we can now go to the next thing and say net asset summary.
The closing balance supposed to be 453 454.6.
454, oh yeah,
0.6.
454.6. So I think if you even calculate the interest based on that, it will not be, the variance will not be as high as that 203 we have there. We have, the variance is not, it's even giving us almost exactly 500. It's giving us 500.1. It means, so we are right. So we have DOA, DOC, PAE. And what do we have in our DOA? We have ordinary share capital for S, 500, 500. We have share premium, 80, 80 mil. Then we have what? Retained earnings. At consolidation, 409. At acquisition, they told us it is how much? They acquired them when their retained earnings was how much? 870. So what else do we have? We have fair value surplus. 50, 50. While additional depreciation is now 30. So what do we have?
So unrealized profit.
Huh?
You know how unrealized profit.
What do you say?
I said unrealized profit.
Unrealized profit. Yeah, good. Thank you very much. Because it is what? It is the subsidiary that is selling to the parent. So unrealized profit. How much? 20. Unrealized profit of 20. So what do we have? Summation here is how much?
15.
For this one,
Yes.
1,500. What about this?
89.
Huh?
989.
989. 989. So for this one, the retained earnings post acquisition is negative 322. So what do we have in total? 372 negative. No problem. So we just proceed. We do the retained earnings of who?
So there's no 322, it's 461.
409. Abi?
Minus 87.
Minus 870. Má bínú, má bínú.
Ah.
Má bínú sẹ́, má bínú, mo ti bẹ́ẹ̀ náà. 461, àbí?
Yes. So
So this should be 511, àbí?
yes.
So net asset summary. Net asset summary of A. We will have date of acquisition, but we will not call it a date of consolidation, rather we'll call it reporting date because we are not consolidating associates. So we have what? PAE, post acquisition earnings. So for this one, ordinary share capital is what? 250. 250 years. Then share premium they don't have. Retained earnings 1002 here. At the date of acquisition, we calculated it to be 750. So what do we have? 450. Then what else do we have? No fair value adjustment, nothing. So we calculate the total. This should be what? 1000. This should be what? 1450. This should be 450. One minute, please. Good. So we have what next? Should be calculating the goodwill. Goodwill. So goodwill will be how much? So for it is S will be calculating goodwill for that will be purchase consideration. The purchase consideration, which is how much? 2041.5. Then NCI. They said it should be measured at fair value, and they gave us the fair value to be how much? 368,000. Then we have what? Less fair value of net assets, which is how much? 1,500. And with that, what do we have as the goodwill?
909.5.
909.5. I think their intention is for us to take all of these figures at round figure. but no problem, it's still fine. That's goodwill at acquisition. Then impairment is how much? 150,000. So if we take out 150, what is goodwill at consolidation?
$759.5.
So I have a question.
What do you say?
759.5.
I have a question.
759.
0.5.
Are you sure? $759.5. Oh yeah, the person that have a question, go on with your question.
For the net asset summary of S, they have
Yes.
positive 511. But for the net asset summary of A, is it not supposed to be negative 450 or it's going to be positive 450?
No, we are doing date of consolidation minus date of acquisition. So if you have 1, 2 minus 750, that's giving you a positive figure.
But the date of consolidation for S is less than the date of acquisition.
And now it's less. That's why we have a negative figure as their post acquisition earnings. Because if we do 409 minus 870, it's giving us negative 461.
Yeah,
Is it
that's what
clear?
I'm saying. That it's not in negative. It's
But
just
sir, the 511 is negative also.
Oh, sorry, oh, it should be negative. I forgot. It's negative figure. Don't mind me. Is the case settled now?
yes, yes.
Mhm. So NCI. What's NCI? Value at acquisition. What is the value at acquisition? 368. Then it will share of post acquisition earnings. We will have what? 20% of negative 511. And that will give us how much? Share of impairments also. Because NCI is measured at fair value. So that will be 20% of 150.
102.2. Share of PAU.
102.2.
30.
30. So if that is all we have, what is the NCI value at consolidation?
235.8.
235.8. So note 14, we can calculate investment in associates. And what is our investment in associates? We have let's do it this way, investment in associates. We will have purchase consideration or cost. What is the purchase consideration? Calculated it earlier to be 500. this. Then what do we have? Our investment in associates will bring our share of profits. Share of profits. So share of post-acquisition earnings. We will have share of PAE, which is what? 30% of 450. And that will give us how much?
135.
That will give us what?
135.
Huh?
So 135.
135. Then aside that, we have what? We're told that the investment in this has been impaired by 15,000. So say impairment, they are not sharing this with anyone. 15. And what else do we have? As for the unrealized profit, it will not affect this one because it was associated that sells here. And the inventory that is having the unrealized profit is in the books of the parent. So the unrealized profit should affect the inventory of the parent. So in the absence of any other thing, what is the value for this?
$620.
620. So for group retained earnings, we have what? Fees retained earnings is how much? 1145. And share of post-acquisition earnings, they will share for S, they will share 80% of -511. For A, they will share 30% of 450. That one is 135. After that, it's better to go to our working one after the other to see what we adjusting. We have what? The unrealized profit is not for him. We have discount on one. $113.1. Then we have what? Share of impairment. For S, they will take 80% of the 150, which should be 120. While for A, they are not sharing it with anyone. They will take the full responsibility for the 15. So what will that give us? Because I don't think we have any other additional information we haven't considered. So what do we have in total? Oh yeah, oh.
Um, 614.1.
Are you sure? Can anyone confirm that I'm getting something else? I'm getting 623.1.
So I not add this 80% times 511.
I did now. So this negative figure, we will deduct it. Abi?
So what of unrealized profits?
Unrealized profits cannot come because the parent was not the one selling.
Eh.
The unrealized profit of the
For
associates.
associates.
It
Nah.
will affect their share of profit. Yes. The unrealized profit of the associate will affect their share of profit. Unrealized profits for the associates. How much is that? 9, Abby? 9. So we have what? What do we have in total?
614.1.
261. Okay. That should be 614.
614.1.
1. Yeah. So that is that. What do we now have? I think that is all we can do. We should now proceed to consolidated statement of financial position. As at 30th November 2007. Non-current assets. What are the non-current assets they have? PPE. PPE is how much? 1750 plus what? 1069 plus what? Plus the fair value adjustment of 50 minus the additional depreciation of 30. And that will give us what? We are not consolidating associate, don't forget. That will give us what? That will give us what? So then we bring
Sorry, sir.
investments. I'm with you. Someone was calling my attention. So for the investment,
No,
we
you
have
were just
investment of
sorry, sir.
1,000. Oh, thank you. I'm feeling really sleepy. I've not had a good sleep in a while. Investment here was 1,825, but we were told that only the cash consideration has been recorded. If only the cash consideration has been recorded by P, and the cash consideration we calculated was how much? The cash consideration we calculated was 1,700. How come they now have 1,825? It simply means they have investment in other companies. So, but it's only that one that is part of the group will be recognized. So that means their investment will be this. And we can now say investment in associates. Investment in associates. And what do we have in investment in associates? 620. Then goodwill. 759.5. So aside that, we can now go to current assets. Inventory. What do we have? 550 plus 230. Then we'll now do what? We'll take out the unrealized profits. So unrealized profit for the one the subsidiary sold to the parent is 20. While unrealized profit for the one they bought from the associate is 9. And that will give us how much? Receivables.
751.
How much? 300 plus 347 what?
751.
751. You guys haven't given me PPU. So for the
PP is
receivables, we have an intra-group adjustment of 50,000. What? And we have cash of how much? 120 and 50. And that will give us what? 170. Summation.
PP is 2,839.
2839. What about investments? That should be
That should be
125.
125.
125. So that's
Summation.
that gives 5,854.5.
5,008
854.5.
854.5. For our equity and liability, we will have ordinary share capital. How much? 1,800 plus the new shares they issue for the acquisition of that 100. That will be 1,009. Share premium will be what? 250 plus the premium on the new shares 400. What else? Retained earnings. Consolidated retained earnings. $614.1. And so that will give us how much?
3164.1.
3161.1.
644.1.
So NCI, what is our NCI? We calculated NCI to be what? 235.8. 235.8. Then we have what? Non-current liability. 10% loan notes. 550. 500 plus 300. Sorry, 500 plus 300, that's 800. Then we have deferred consideration, don't forget. And how much is the deferred consideration? It is 341.5 initially. Then there was a total a total discount on it of 113.1. How much would that give us in total? It give us 454.6. 454.6. Then the current liability, let me just put it here. We have trade payables. $520 plus $330 minus the intergroup account of 50. How much would that give us? Income tax. What do we have? 330. $330 plus 70. What do we have? 400. This will still be 800. What's the summation? Yeah, figure. Oh yeah, oh. That will also give us 5854.5. Is it clear? Is it clear? Is it clear?
Yes, sir.
Because I don't have the strength of what you guys are making me go through this night too. So while we are at that, let's do question 5. Question 5 is on consolidating SOPL of an associate. And once we do that, we may have to call it a time. Oh yeah, who is holding?
Question 5. Below are the income statement of the Barbie Group and its associated company as of 31st December 2088. What figures are going to be correct? Additional information 1. Barbie acquires 5,000 ordinary shares in Ken a number of years ago. Ken has 50,000 $1 ordinary shares. Barbie also acquired 60,000 ordinary shares in Shelley a number of years ago. Shelley has 200,000 shares, one ordinary shares. During the year, Shelley sold goods to Barbie for $28,000. Barbie still owes some of these goods in inventory at the year end. The profit element included in this remaining goods is $2,000. NCI evaluated using the fair value method. Goodwill and investments in the associate were impaired for the first time during the year as follows. Fairly $2,000, Ken $3,000. Impairment of subsidiary goodwill should be charged to operating expenses required. Prepare the consolidated method. Consider income statements for Barbie, including the result of its associated company.
Okay, thank you for that. So, like I said, that one is on income statement consolidation. And just like we have in the case of the first one we looked at, it has both associate and subsidiary. So you can see they did not tell us which one is associate, which one is subsidiary. But we have Barbie Group. So we'll say note 1, question 5. So we'll have in 1 percentage of holding. So we can know what we are doing. The percentage of holding for who? For Ken, they said they acquire 45,000 shares there. 45,000 shares. Divided by how many? They said Ken has 50,000 $1 ordinary share. So 50,000 $1 ordinary share. I just say divided by 50,000 shares. Because the 50,000 is the number of shares. Multiplied by 100. That will give us what?
9.
Eh? What do you say it is? 90%, have we? Then they said they acquired 60,000 ordinary shares in Shelley. In Shelley, they acquired 60,000 ordinary shares, where Shelley has 200,000 ordinary shares. And that will give us what percentage? Oh yeah, kí ló tẹ̀ ń ṣe báyìí lálẹ́ yìí? 30%. So we already know Ken is the subsidiary, while Shelley is the associate. So we'll have Barbie acquiring Ken 90%. NCI 10%, Aquari Shelley 30%, date of acquisition and date of consolidation. I think they were both okay. They did not tell us the date they acquired them, but the date we are consolidating for is what date? 31 December 20x8. So what do we have next? During the year, Shelley sold goods to Barbie, that is, associate is selling to parents for 28,000. Barbie still holds some of the goods in inventory at the end. The profit element included in this remaining goods is 2,000. So what do? We say unrealized profits. Shelley to Barbie. That will what? So that will just be the 2,000. That will be to the 2,000 multiplied by what? Multiplied by 30%. Don't forget their unrealized profit. The unrealized profit in the associate will be accounted for at the percentage they are holding there. So that will give us how much?
600.
600 is the unrealized profit. Okay, so we have what? Non-controlling interest are value using fair value method. Can check this thing. Then the third what? Goodwill and investment in associate. We are impaired for the first time during the year as follows. Impairment of subsidiaries goodwill should be charged to operating expenses. Okay, so what do we have? That's all we have. So the only thing we will now do is what? So I think we can just go ahead to consolidate since we don't have any serious adjustments. So we have consolidated statement of profit or loss. For the year ended 31 December 20x6. So what do we have in the consolidated SOP? We'll have revenue. But don't forget, we are only consolidating revenue of parent and subsidiary. So we will not consolidate associate. Had it been that intra-group sales was for the subsidiary, we would have taken it out as intra-group sales. But because it's for associate, we are not doing that for associate. What do we have next? Cost of sales. And that's how much? 185 plus 60. 245. So we have gross profit to be how much?
240.
240. Then operating expenses will be what?
50 minus 15.
We are not 50 minus 15. It should be 50 plus 15. No? Then they said the impairment of subsidiary goodwill should be charged to operating expenses. And what's the impairment of subsidiary? 3,000. 3,000 is the impairment of subsidiary goodwill. So we'll say plus 3. That will give us 68.
Yes.
But mind you, the impairment in the what is it called? In the associate, we should have charged it as 2,000. Then unrealized profits. Unrealized profit. You know, there was unrealized profit of how much? Of 600. We should have adjusted it because that inventory would have formed part of the closing inventory of the parent they used in calculating this. So we should have bought the unrealized profit 0.6. So what would that give us? That should have been 247.6. I mean,
So how do you think you are saying now? Yeah, I don't even understand.
you don't understand which one. When
Sir,
we
the
were
0.6 is from where?
it's for the unrealized profit. This one here. You know,
600.
Shelley sold to Barbie, Abby, and Barbie is here to sell those goods.
Yes.
And we say the profit element on it should be recognized. But that profit element is part of what Barbie would have used in calculating their cost of sales. So to reverse it, that's why we are adding this back. Is it clear? Do we understand? Hello? Hello? Hello?
Yeah, I can hear you.
You can't hear me. I'm asking, do you understand it now?
I did not hear you before now.
I said Shelley sold goods to Barbie. And on that goods, 600 is yet to be realized as profit. But Barbie would have used the total value of their closing inventory to calculate their cost of sales. Now that we have unrealized profit, we have to add it back. Like we normally adjust unrealized profit now. Or is that not how we have been adjusting unrealized profit in our SOP?
Yes.
So this will be 237.4. Then we have this to be 68. We will now say share of associate profit. Share of associate profit. What will be our share of the associate profit? We'll only take 30% of how much? What profit did they make? 20 is their profit for the year. 20. And I did not bother doing any adjustment because we don't have any adjustment to it. 30% of 20 will be what? 6. Then we can now bring tax. And how much is the tax? 50 plus 12. That's 62. What do we have as profit for the year? Oh yeah.
113.4.
113.4. So what will now be the profit of the year attributable to owners of Barbie and NCI? NCI will get what? 10% of what is their own profit, 13. And I'm using their profit directly also because it doesn't have any, it should have adjustment. So NCI is measured as fair value. So what we should do is we can just make it the adjustment here. Since NCI is measured as fair value, we should take out the impairment of the goodwill before arriving at anything. So we have what? 1. And owners of Barbie will take 113.4 minus 1. And that will be 112.4. Is it clear?
Yes, sir.
So that is that. Any question for me?
Good.
Hello?
Now question.
Okay, so that's that. Can we still look at one more question, or we should just call it a time?
So let's go
Let
with
us call it a time for now.
She called it a time. Oh,
We've not even used 1 hour 30 minutes. We are saying call it
That
a time.
we've used 2 hours.
At where? What does power me?
We started since 8:45.
We did not start at 45 because